Okay, I think we are ready. Mitchell, can you hear me?
Ready? I can hear you, Eduardo.
Oh,
yeah.
fantastic. So, Mitchell, the
Yeah,
floor is
kind of
yours.
Yeah, perfect.
Thank you very much. Please, go ahead.
Shall I start?
Yes, please.
Okay, thanks, Eduardo. Thanks to everyone for patience with the technology. So I'm going to talk briefly about my paper entitled Collecting the Rent. This is co-authored work with Joe Bankman and Al Sykes, both at Stanford. Let me just give you the quick thumbnail, 2 takeaways from this paper. First off, this obviously intersects quite closely with work that OECD is doing now and issues that a lot of people are thinking about in international taxation. But this project's been underway for 3 to 4 years, actually, and what we're engaged in is really a comparative, largely descriptive study of legal instruments, tax and non-tax. So it's not exclusively a tax paper. We're thinking about non-tax as well and the way tax and non-tax substitute for each other on the margin. Second, the key motivation of the paper is to think about market power from the standpoint of governments and jurisdictions seeking to capture rent. So we want to think about monopsony power of governments as opposed to the monopolistic power of firms, and think about how these different legal instruments are relatively constrained or not in terms of firms exercising that market power. So quick overview of the talk on the screen. I'm going to, first bullet point, I'm going to start off, just want to give you a little background on how I got into this in terms of the connection to LSAs and market power. And then the bulk of the tax is all the the middle bullet points. I want to just give an overview of the various instruments we talk about. And then lastly, just a minute maybe to open it back up into some of the more topical discussions. So why don't we flip the slide if we can?
Yes. Yes.
So in terms of the lead into this paper,
Yes.
there we go. Okay, thank you. All right. So I got into this a few years ago because I became quite interested in the topic of transfer pricing of location-specific advantages and labor rents in particular. And I was looking at the problem that we're familiar with where you outsource labor inputs, and that creates some firm profit, at least in the short run, until the firm passes cost savings forward to the consumer. And so I wrote 2 papers on this, which are mentioned on the board. It is a narrow transfer pricing question about how a firm should compensate a local subsidiary that is providing relatively low-cost labor inputs. And so this, famously is played out, for example, in disputes as between the United States and China. The United States takes the view you should compensate the local subsidiary at the local market price, meaning the local sub doesn't capture any of the surplus. The U.S. says this is all about brand, doesn't acknowledge really an LSA. China, by contrast, would say, no, it's really all the LSA, and so you should compensate the local sub at a much higher rate. And in these papers I wrote, I took the view that really both of those views are incorrect, that what's happening here is a complicated, dynamic problem. So first off, the U.S. seems clearly wrong to me. It's not about brand. And in fact, when you outsource, you often suffer brand degradation if consumers don't like the idea of you using low-cost, unregulated labor. But the complication is that the surplus will dissipate over time as the cost advantage is passed forward to the consumer. It doesn't happen immediately, but it does happen over time. So one insight I had was the way it seems in theory you could measure what the host jurisdiction where the labor input is provided, the way you could measure what belongs to that jurisdiction is by thinking about their market power. And so if, for example, the provider of those labor inputs were to nationalize the sector where the labor is provided and just bargain for the best price it could get from the foreign firm, then it should be able to capture the surplus measured by the difference between its cost and the next best cost in some other jurisdictions. So it's much like the way a country could bargain for rents if it had natural resources in the ground. My argument was, well, if you could bargain for something in a nationalized sector, then that gives us some identification and purchase on what part of that surplus ought to belong to that country. So one, you can flip slide here. So one pushback I got on that when I presented these papers was, well, why would you just hypothesize market power in the jurisdiction that's providing factor inputs? What about the jurisdiction at the other end of the supply chain? What about the consumption jurisdiction? And indeed, that's a powerful point, and that's how I got into thinking about this paper. So you can flip the slide again. And I started wanting to ask, how should we think about the market power of what we could roughly call the jurisdiction of import of finished goods when figuring out how much tax base to allocate to that jurisdiction? And at this point, this is when I started working with my two co-authors. So Joe Bankman, also interested in this question. Al Sykes is a trade law expert. And the reason we brought a trade law expert on board is that we realized that this question is really trans-substantive. That there was no reason to limit ourselves to thinking about tax if the question was, right, how can a jurisdiction exercise market power as against foreign firms? So I have an example on this slide, and this is one we like to use to frame the paper, which is to think about a pharmaceutical company that wants to sell drugs into a host jurisdiction. And we know that from an income tax standpoint, pharma has been quite successful at keeping any rents outside of the reach of the importing jurisdiction. So they play the standard game, avoid taxable presence and make high deductible payments out of the local jurisdiction. It can be quite hard historically to reach that through an income tax. By contrast, if you considered that jurisdiction to nationalize its purchasing power, say through a single-payer healthcare system, which said, hey, if you're going to sell drugs, pharmaceuticals into our country, there's one buyer, it's the national healthcare system, here's our price, take it or leave it. Say the pharmaceutical company likely takes the price, as long as it's still over marginal cost, then that bargaining for price reduction is economically equivalent to taxing the foreign firm and passing that tax on to local consumers through some subsidy or price reduction on the drug. So that struck us as interesting, that we observed very different legal constraints on how jurisdictions can exercise their market power, whether they do it through an income tax or by contrast through some other legal instrument. So that's what got us going on this question. And we started thinking about what are the whole range of legal instruments you might see in that kind of circumstance to exercise market power, and how do the legal constraints apply differentially. All right, we flip the slide, please. And the next slide just references the fact that we pick up in the paper on classic economic definitions of rent and quasi-rent. There are empirical problems about differentiating the two. There are empirical questions about how large true rents are. I'm going to gloss over this now because I know we're short on time. But there's nothing super novel going on in that sort of part of the paper other than to justify our decision to talk about rents, notwithstanding the empirical problem. All right, so if we flip the slide again, this slide is basically the bulk of the paper. So we go sequentially through these various instruments, splitting tax and non-tax. Let me make two introductory comments. First, on the tax side, we don't talk about something that you might have thought we should talk about, which is we don't talk about residence-based taxes. We don't talk about CFC rules. We don't talk about the U.S. GILTI regime. And that was a reflected decision that residence-based tax is fairly uninteresting from this standpoint. So what we're interested in is what are the legal constraints on exercising market power. And we know that in terms of residence tax, there aren't really any. So any country can really, as a legal matter, pass expansive CFC rules and include everything currently, and you would reach the rents of home country firms that way. There are good reasons not to do that, as we know. Your firms will flee or be acquired by parent companies in other jurisdictions, but that's not a legal constraint on exercise of power. So we really focus the tax discussion on the inbound context of a country trying to tax foreign multinationals, not their own multinationals. Second overall comment here is in the tax discussion, we distinguish among three hypothetical stylized businesses we call software, computer, coffee. So obviously, modeled on Google, Apple, Starbucks, roughly, to make the point that based on business model and firm structure, the legal constraints are going to apply differently. And that, interestingly, is a distinction we make in the tax discussion, but not the non-tax discussion. So that's an interesting conclusion of the paper in itself, that tax instruments seem more sensitive to firm business structure than do non-tax instruments. In terms of the instruments themselves, let me just go through these briefly since we're familiar with a lot of this in this group. There's not a lot of novel analysis in terms of the technical tax piece, but I want to use it to draw out some general conclusions. So in terms of tax, we say we think there are basically three sorts of broad instruments one might use. So a source-based tax with separate entity accounting as modified on current development. Second, some kind of formulary approach. And third, some kind of shift to a consumption-based as under like a DBCFT. So in the one word I want to pull out of my discussion of all three of those is the word entity. Okay, so let me explain what I mean by that. So in terms of source-based tax, we observe, historically it's been hard to use source-based tax with arm's length transfer pricing to effectively capture foreign MNE rents. That's the whole situation we live in at present. That doesn't mean you can't restructure a source-based tax. So we're observing this minute by minute in the OECD work. So it seems to us there are three basic strategies that everything falls into. You can look at the foreign firm and expand your rules on taxable presence and allocation of base. That's strategy one. Second, you can use bolstered withholding taxes on local firms in order to collect tax on the foreign firm you might not otherwise be able to reach. Or third, you can just go after the local firm, but in that case, you need to do it within what we'll call an artificial base, as under the U.S. BEAT, artificial in the sense that you're clearly denying deductions that are clearly costs of earning income in some sense. So all of these are possible, and we are currently observing them. Our point is that they are costly. Remember, this is a comparative analysis of which instruments might be preferable. Remember, the operative word here is entity. So I think the reason these are all costly is that we're grappling with the legal constraints on what entities you can reach. And the basic constraint are international law limits on reaching foreign entities. So we need to make complicated rules that say, no, we can reach you even though we used to not be able to. Once we can reach you, we need further complex rules on what your allocable base is. Withholding taxes, artificial base definitions, those I see as all backstops to what might be thought of as the first best, which is just reaching the foreign entity in the first instance. All right, formulary apportionment in its historic guises or its new, more modern guises, as under the RPAI or the sort of formulary proposals we're seeing in the OECD work on digital tax. These two suffer from constraints all related to entities. So we sometimes think, formulary apportionment solves the entity problem by getting rid of separate entities and the need to do arm's length pricing. But of course, apportionment doesn't remove entities from the picture. You still need a taxpayer. Taxpayers classically under formulary approaches may try to channel sales through unrelated parties to break the unitary enterprise. If they do that, you need some rules to collapse the unitary enterprise back together or look through the intermediate unrelated entity. Similarly, as we see in the recent OECD work, another problem with potential apportionment is depending on what the factors are, you might stuff things inside the unitary enterprise to skew the apportionment. So with sales-based apportionment, we start to worry about high volume, low margin sales packed into the entity. How do you solve that? You carve the entity by looking at something like a line of business rather than the whole entity. So again, you can do it, costly, complex, all complex because of the need for the income tax to deal with the entity as the fundamental legal unit as the taxpayer. Finally, DBCFT, in a way you think, okay, consumption on consumers, maybe that gets us away from complexities of corporate entity status, but not quite. So one serious limitation on DBCFT is, remote business to consumer transactions and enforcement needing to get the remote business to register. So the same problem we have with destination-based VATs and B2C transactions. So again, in all three of those, we see what we consider to be an entity limitation. In terms of non-tax, what's interesting is we don't see that limitation or constraint, but we see other constraints. So government purchasing is really interesting. That's the one I started with in terms of the pharmaceutical. And we observed there that, interestingly, there are basically no legal constraints we can identify on exercising centralized purchasing. The only one is if you buy it and then mark it up and then resell it in the local market, then that can be treated as a deemed tariff under GAAP. But if you're not doing that, if you're just buying it on behalf of consumers and letting them enjoy the lower price, you can do that. There's no legal limit. However, there's a super high informational constraint. So what might work for drugs is not going to work for iPads. So imagine centralized group purchasing of iPads or tablets and the government having to figure out how many to buy, what price to buy, and how to distribute them. So drugs work because we know who needs them, because we have an independent professional body of doctors telling us who needs them. For basic consumer goods, we're not going to have that, so the informational constraint is very large. Price regulation faces the same information constraint in addition to a legal constraint because of national treatment requirements under GAAP. So you couldn't have a price floor for a foreign seller and not for domestic sellers. In terms of the last three, we have some other interesting observations here as well. So antitrust enforcement, again, you might not naturally think that as a substitute for tax, but it's another way to exercise market power if the country has it. That is, by strict antitrust enforcement or threats thereof, you could extract price concessions through a consent decree or something like that. There are few legal constraints here. Again, unlike tax, we don't see a lot of legal constraints. You need to identify some anti-competitive behavior, of course, but that might often be ultimately resolved by adjudication in local courts and not meaningfully constrained. Tariffs can be an effective way to, of course, distinguish imports from domestic production, which one might see as the basic goal here. But of course, tariffs suffer from substantial legal constraints under WTO law, so not an obvious way to capture substantial amounts of foreign MNE profits, current trade wars notwithstanding. Lastly, excise taxes we view as interesting and promising because they allow you to bypass legal constraints by being facially neutral. So you set an excise tax on a certain good, but if that good is predominantly served through imports and not through domestic production, then you effectively get a distinction in who you're taxing, who you're reaching, in a way that is not subject to legal constraint. We view DSTs to basically be an example of exactly this. All right, let's switch the slide now. Last main slide. In terms of the general comparison of instruments, I think we do find some interesting conclusions. Number one, there's no single best instrument across the board. So you might have thought the output of such a study would be, okay, we're going to identify the best instrument. That doesn't work because, in part, different instruments work differently for different business forms and sectors and organizational form, and also because different instruments work differently depending on what the information constraints are on the government. So in terms of the constraints we identify, we like to think of three. So there are the legal constraints tied to entities, and those particularly plague the tax instruments, but not the other instruments. Then we have legal constraints not tied to entities. So these are ones that derive generally from trade law, GATT, possibly from competition law, if there are limits on what counts as anti-competitive behavior. These are really not tied to entities, especially in the trade context, and that reflects the fact that although economically they're doing similar things from the standpoint of our question, they have very different historical evolutionary paths. So the reason we focus on entities in the income tax has to do with concerns historically of double taxation and the fact that, right, an entity you're reaching might also face residence-based tax. That's just not an issue that's at play in trade law. And then lastly, as I've mentioned, we have the informational constraints in certain contexts. In terms of the last bullet point there, we don't make any grand predictive conclusions in the paper. If you thought about this paper as a kind of pragmatic guide to policymakers who are trying to figure out which arm of government to go to reach these profits, there is, for the reasons just noted, no single best instrument, and yet we do identify excise taxes and antitrust enforcement as two instruments that seem relatively underused to us, given their comparative advantages to some other instruments that we discuss. The last point and last slide is blank. I'll just throw it out there in 30 seconds to preserve time for discussion. This is not in the paper. It's something I've been thinking about, which brings me full circle in my thinking about market power. So as I noted, I started all of this by thinking about LSAs, providers of low-cost factor inputs. So think about that as one side of the global supply chain where things begin. The focus very much in the world right now is at the other end of the supply chain on ultimate consumption. As we see, we're moving towards relaxed standards of taxable presence that don't look to physicality, but look to some other kind of economic presence. And I'll just throw out the following query. If you look at the recent OECD work carefully and read all the sentences in there about taxable presence based on an economic connection with the so-called market jurisdiction, I think most of those sentences you could cut and paste and apply as well to a different market jurisdiction. That is the market where the initial factor inputs are provided. And so the query is, if you write a legal rule where taxable presence is now about economic connection, why do we care only about the jurisdiction where you sell ultimately and not the jurisdiction where you initially acquire factor inputs? Again, that observation and where that leads us will have to ultimately intersect with where jurisdictional market power lies in the two jurisdictions. All right, I'll stop there, and I welcome the comments. Thank you.
Can you hear properly, Mitchell?
Hello, hi, Mitchell.
I can hear not so well.
Okay, I will do my best.
Nice to-
Wait a see. It's here. The microphone.
Okay.
Yeah, the microphone is here.
So do I need to talk to look at
Have to shout at the iPad.
I see.
Just a second.
Hi, Mitchell, can you hear me? Hello?
I can hear you now.
Okay, great. Thank you very much for your excellent presentation. First of all, I want to say I enjoyed reading your paper. Collection of multinational companies' rents has been an important issue widely debated at both international and domestic levels. In my view, it has only raised more attention in recent years due to some high-profile tax avoidance cases. Your paper discusses the issue from a much wider, more comparative perspective than the existing scholarship that focuses on either a tax angle or a trade angle or any other regulatory instrument angle. I have some general comments and also questions. Firstly, the first comment is that as you and other authors have observed, collection of rents within the borders of a country or region would be relatively easy as a result of tax sovereignty. But it would be challenging in cases involving cross-border activities engaged by multinational companies originated from other jurisdictions. Due to this consideration, your paper focuses attention on how to collect rents from non-resident multinational companies by the importing nation. So here, an implicit assumption of your paper is that the residence status of a given multinational company can be determined for the purpose of rent collection. However, I think in practice, a multinational company may be regarded as a tax resident in more than one jurisdiction, which means a foreign multinational company may be regarded as a tax resident also in the importer nation. Which means, this may render some tax measures targeting purely foreign multinational companies by the import nation less effective. Certainly, in this circumstance, the import nation can just use its state power to collect rents from the multinational companies if it so wishes. Because in this case, this is now within the sovereignty of the import nation. A related point is that if determination of the tax residence of a multinational company is relevant, claims to collect rents arising from, for example, intellectual property rights or organizational synergies may overlap among jurisdictions where the multinational companies operate. This may seemingly cause double taxation to multinational companies depending on the degree of their operation and the applicable tax rules in the relevant jurisdictions. So this goes back to the international tax system. As pointed by you and other authors, the current international tax rules, even with changes introduced by the BEPS project, have not been effective in helping governments collect super rents from foreign MNEs. And the proposed new taxation rules may not work well in all circumstances too. So we may need to look at other non-tax policy instruments. So the second point is about the analysis of tariffs. I think the analysis is important. In theory, the tariffs are paid, I think, not by the foreign multinational companies selling goods or services to consumers in the import nation, but by the importers. And the import nation may not capture rents, but rather it collects higher consumption taxes from its own businesses using the imports as inputs or its consumers. The higher consumption taxes could make imported goods or services less competitive in the import market, and as a result, this could decrease demands for the goods and services in the import market. On the other hand, given the analysis is about multinational companies, so I think probably you may need to note generally multinational companies have integrated systems where there is a close connection between the importer and the exporter. In a sense, then, the whole multinational company is paying the tariffs, whether the actual payment comes from the either the importer or the exporter. So probably, I think you can further elaborate on this issue in the paper or in your response. The third comment is about the paper's emphasis. You and other authors have argued that national market power is crucial to a nation's capacity to capture rents from multinational companies, which is on page 10. And also you have argued that only if firms cannot replace lost business opportunities in the nation seeking to capture their rents with equally good opportunities elsewhere, will the nation have any leverage to extract rents, which is on page 11. This would probably be true. Imagine the consequence of, for example, losing the Chinese market on Apple's profits, or the profits of the luxury brand Chanel, for example. However, if this is true, what about price taker jurisdictions? You also have analyzed the situation for price taker jurisdictions in the paper. Does that mean that the price taker jurisdictions would inevitably suffer from the exploitation of their markets by foreign multinational companies? Would the joining of a regional trade agreement, for example, help address the problem for those jurisdictions? In the case of jurisdictions, they have monopoly power. You argue that these jurisdictions can exploit such power to capture rents from foreign multinational companies in the form, for example, of the lower prices of goods and services for their consumers in the market. This may not always be the case, I think, in practice. For example, for Apple products sold to consumers in China. Although collectively China's consumers have the power to influence the price they pay, the country has not been able to extract extraordinary rents earned by Apple, the company, from sales to the customers in China, either by tax or non-tax policy measures. I have two more very minor comments. So the fourth comment is about dumping. You refer to this meaning sales that involve international price discrimination or sales below cost. Well, the WTO meaning of dumping is that generally refers to a situation of international price discrimination where the price of a product when sold in the import country is less than the price of that product in the market of the exporting country. I was wondering if you can elaborate on the difference in meaning between the meaning in your paper and also the WTO meaning of dumping. In part 3, you do not refer to the running examples, the 3 running examples of computer software and coffee for analysis purposes. Somehow I feel this is a pity, given that you are comparing tax and non-tax responses to rents collection. Using the examples to illustrate the efficacy is a very interesting and I think effective approach, which has done very well in the paper. So probably I think you may consider going back to the running examples in part 3. Lastly, you mentioned in the beginning that the paper's central theme is to examine a host jurisdiction's ability to collect rents, and of course depending on its market power. I think the paper has successfully achieved this objective, offering a complete picture of the issue. As found by the paper, existing tax rules and the proposed new rules are not very effective in collecting, especially for multinational companies' rents in the import nation. And the international trade instruments are not always effective and subject to various legal constraints. Indeed, in the globalization of the economy, multinational companies have been able to drive reforms and changes to international trade, and I will finish very soon, and the tax policies to facilitate their business operation across borders. They have very successfully advocated for the broadening, for example, of market access and the protection of intellectual property rights and the introduction of legal constraints on countries' use of regulatory instruments in international trade treaties and public international law. So in a sense, I think, in my view, multinational companies are the biggest winner in the economical globalization. The essence of international trade and investment law is to control government's regulation, but not under-regulation or no regulation. And therefore, tax loopholes in international trade and investment are ignored from trade treaties or from based on international trade treaties or investment treaties. So to sum up, I think your paper has made a great valuable contribution to the existing scholarship on tax, on international tax and trade, reminding us of the problem relating to collection of rents from multinational companies. The analysis of the paper offers a solid foundation for future research in this field. So yeah, that's the end of my comments. Thank you very much.
Thank you.
Okay.
The room is yours.
Thank you very much. Can you hear me?
Yes.
Yeah.
I can hear you very well. Thank you.
Okay. So thank you very much for your paper. I concur with what has been said. The fact that the analysis that is made is using a different tool than just focusing on tax design adds a lot to the discussion, because beyond pure tax instruments, there are also other policy instruments that can be used. If taxation is clearly the main, if not only, instrument to provide resources to public authorities, it is far from being the only regulatory instrument in order to influence the allocation of income and wealth between corporations and their stakeholders, shareholders, employees, consumers, and states in the international context. And that being said, and that's maybe a first question I have, the objective of the paper seems to go beyond the title, because sometimes it seems that it's not just about how states can extract more rents through their tax system on multinational, but it's more about how those rent can be redistributed between corporations, states, and other stakeholders. Anyway, it's fundamental to address this issue too when it comes to trade policy and inter-nation equity. The risk with such an approach, however, is where to put the boundaries to the type of instruments of public policy that should be analyzed. Because, and I'll come to that later, when it comes to the digital economy, it appears fundamental to address issues of data protection, IP legislation. As regards, first of all, the remarks that I have more on the content of the paper, would like to concur with the authors that the central goal of any economic policy should be to discuss how to gain or to preserve market power towards economic actors, and to reach a balanced relationship between states and companies, and all instruments of public policy should be used. But I'm wondering whether the relationship between the application of taxes and market power is not even more intricate than it appears in the paper. Because, of course, taxes, as it is clearly shown, may indeed directly or indirectly diminish profits in the hands of corporate taxpayers, and therefore being a disincentive to be economically active in a country. But taxes on corporations can also be redistributed, which means that they can be transferred to other economic actors than shareholders, and therefore they are likely to increase disposable income and wealth and consumption possibilities on those actors. For example, so poorer citizens can receive more subsidies, by the states if the state increases taxes, and therefore they are more likely to consume. At the same time, even richer citizen, wealthier citizen can benefit from redistribution by using their disposable income not only to necessary expenses, essential goods like food or healthcare, but turning that to other type of consumption if there is a state intervention, for example, in healthcare. Which means that paradoxically, by levying more taxes, sometimes you manage to increase your market power because you transfer more power to your consumers, and that's maybe an element that can be taken into consideration. Another aspect, I totally agree with the theoretical distinction that is being made between the different tax instruments that can be used to increase source taxation, but in practice, those different types of tax instruments can be combined. So if we look at increasing PE presence or using formulary apportionment by destination-based tax, or you can combine those instruments. So for example, you can introduce targeted limitation on the deduction of expenses that are subject to a transfer pricing analysis on the reasonableness of the amount of the deduction, or you can, for example, introduce new excise duties like digital taxes using apportionment mechanism that are usually using criteria that are usually applied as regard apportionment of corporate tax. So the combination of those different instruments can lead to better, actually, instrument. As regards the discussion on VAT, the point I wanted to make is that VAT can be very useless when it comes to B2C transactions, but let's not forget that in the ideal system, B2B transactions are supposed to be VAT free, or at least there should be a compensation for business to pay VAT through the application of the right to deduct. So in that sense, they're not comparable to destination-based corporate taxes, since destination-based corporate taxes tend to include B2B transaction in the taxable base. And then that's the point I made in the beginning. Other policy instruments, other non-tax policy instruments that may play an important role in affecting the rent of multinational companies. And there I turn on all the types of legislation that affect the value of rent-creating assets. And when it comes to digital, companies, those rent-creating assets are IP rights on the one hand and data on the other hand. And I think, and we'll have a real life example now in Europe to be analyzed, that an efficient data privacy legislation can have an impact on the value of the assets of companies who deal with data on a day-to-day basis and who try to extract rent from those data. The same, and another example, if you impose a legislation as regards the use of data, if you force companies to make their data available, of course, on an anonymized way, if you force those companies to make that data available to the public and to competing corporation, of course, that has an impact also on the rent. R&D policies also can play an important role. You mentioned pharmaceutical companies. In some countries, pharmaceutical company have been forced to grant licenses to competitors. This also have a strong impact on their power towards the state. R&D investment, you talked rightly about the fact that government could buy services and goods, but it could also fund R&D, and entering into some kind of agreement with the companies it funds, and therefore having an impact on how those companies will use for private purposes, for profit purposes, the IP rights they will have developed with public funding. And you can also influence the type of company who benefit from that public funding on their R&D, and therefore attracting more company on your territory, of managing to retain those company on your territory. Therefore, that's my point. Where do we have to put the boundaries to the type of policy instrument we can use? But I'm convinced we have to analyze them all if we want to make sound policy. And finally, I totally agree on the fact that specific excise taxes on certain types of activities should be used better. We've got already a lot of experience as regards energy taxes in Europe and in other countries, as regards what is positive about those type of instruments and what is more problematic. And in particular, when it comes to excise taxes on digital products, we should be aware of the fact that if you target specific type of goods or digital goods and services, you will have to find a way to adapt your list very quickly. Otherwise, it's the problem we have in Europe with the energy tax directive. There are new sources of energy that fall beyond the scope of the directive, or that we cannot grant incentive for, simply because it's too difficult with the unanimity requirement to change legislation. So we should be very careful. For example, if we enter into some kind of international coordination on taxation of digital companies, not to end up with an agreement on a list that will be completely outdated at the moment it will be agreed upon. But there are ways to solve that kind of problem. So that was it. And thanks again for your wonderful paper.
To offer a philosophical perspective, well, by Manuel Boyakis, who is an associate professor of law at LSE.
I see people here philosophical and they're already laughing, so which tells you probably something true. Right now, I could write a paper exactly on the ways in which I'm not qualified to comment on this. Well, actually, my own research is mostly in the field of private law, and the main question that occupies me is how do the liabilities people have depend on the opportunities they have and the choices they make? And lately, I've been interested in how that connects with issues of tax justice. So how much the tax burden you bear depends on the opportunities you have in a society. And that's what probably encouraged Eduardo to help me get out of my shell and come and make some comments on this. Now, some of the points that I have actually been made, so I will not waste people's time in repeating them. We'll just identify one or two where I just agree with what has been said. So the paper says that there is no systematic attempt to analyze the benefits and detriments of the full range of policy instruments. There is, and the paper claims to do that. Does it deliver? Absolutely. And it maps out, describes sort of the options and the context, and offers hypotheses as to which options likely to work out in which circumstances. The core claim is the ultimate ability of a jurisdiction to capture rents from foreign MNEs is a function of the extent to which that jurisdiction has monopsonistic market power. And I think the paper backs that claim fully. Now, I have two substantive points to make. The first one was alluded to by Eduardo, although I think I'm going to take a slightly different angle to him on this. Now, while the paper is called Capturing the Rent, I'm not sure that the notion of the rent is actually crucial to the paper's argument. It seems to me that the paper's analysis would hold good, even if the aim of the host jurisdiction was not to capture rents, but to ensure that the multinational enterprise is subject to an effective tax rate. You would still be using, let's say, the tax instruments in question with the same purpose and hit upon the same difficulties. I think the point becomes clear. It's not a sort of very friendly observation, because you yourself, when you discuss whether a rent is true or quasi, you say it doesn't really matter. You contrast, for example, a pharmaceutical company that invests, sort of makes rents in one drug and then invest them in research and development for another. And we can contrast that with, let's say, Amazon. Using rents made in book sales to expand aggressively into groceries. Now, the game there will be, the state will regard the book sales as generating true rents. Amazon will say they're quasi because, we're funding the grocery business. The state will say that these are different business lines, and Amazon will say define different. Either way, the idea is that the government itself doesn't really care whether the rent is true or quasi. But I think the same would hold if if it's not really a rent. If the government regards it as a rent, it will chase it in the same way. And actually, it seems to me that the multinational's response will be exactly the same whether the rent is true, quasi, or not a rent at all. In all cases, it will seek to, it will exercise the threat of withdrawing from the jurisdiction and moving its activities elsewhere, for example. Now, I can cut through this because I think Eduardo covered it. So basically, the bottom line is that it seems to me that whether we're thinking about capturing rents or maximizing tax revenue or ensuring that the enterprise pays an effective tax rate, the analysis of the paper still holds true. The second point, and I think sort of again, I'm not going to be saying anything terribly new, is this. So given the analysis of the paper shows us that the prospects of success of different policies, tax and regulatory, vary depending on the kind of policy you have in mind. So the next question in my mind is, what should a host jurisdiction do? What's the playbook? And the obvious answer, coming from your headline claim, is that the jurisdiction should find where it has monopsonistic power and use it. But I think there's a case for a further answer too, and kind of maybe a little more dramatic answer. Given the fact that the different tax and regulatory policies that you examine work only in some jurisdictions, in some industries, under certain favorable conditions, maybe only for a little while, and they generate low or modest returns at best, maybe the optimal strategy for the host jurisdiction, if you want to write the playbook about under the conditions identified in your paper how the host jurisdiction should play the game, is really the same as the strategy of a weaker party in any kind of asymmetric warfare. And I'm thinking here, basically try guerrilla tax tactics. And when I was thinking through that, it occurred to me that the title "The Art of Tax War" is you may want to add Sun Tzu meets international taxation. It's there for the taking. Nobody has used it, so feel free to capitalize on that. There is an article called "The Art of Tax War." I found that in the New York Times. I think it's the first Google hit you get, but it relates to the Bush tax cuts. So it's the field is still virgin territory. Now, what do I mean by that? That if I were the host jurisdiction, I would want to use not simply the whole gamut of the instruments that you identify, but I would also want to use them in a messy way, loosely, and not wholly predictably. And here's what I mean. So for example, you can use VAT on some products, a destination-based cash flow tax on others, excise on others still. You can use state purchases, as you say. Also use tax shaming. You actually mentioned that a little bit, but it's not a sort of a separate focus for, I think, obvious reasons. But what I was particularly struck about, and this is sort of where my background in legal philosophy came in a little handy, is that there's another possibility. The host jurisdiction can also use, to its advantage, the complex and polycentric character of decision-making in modern legal systems, to capture the rents through the messiness of its own decision-making procedure. And what I was thinking about, you do mention in the paper that decisions in tax cases by courts have a special effectiveness. And that seems to me absolutely true. But maybe there's another lesson to be learned there. So tax disputes, both before national and international fora, take a long time to be litigated. That is useful time for the host jurisdiction sometimes, or it can be made useful. So I can imagine the host jurisdiction playing the game of advertising a low rate of taxation, leaving courts to do the dirty job and hit a multinational with tax hikes retrospectively. Then, the multinational complains, the host jurisdiction aims for a tax settlement, and in the end you may end up with more tax revenue and more captured rents than you would otherwise. In sum, I suppose my point is that in the conditions that the paper identifies, maybe there is a complex strategy in which the host state can capture more rent by not speaking with one voice, using the sort of the messiness of this procedure. I think, I don't know enough about this, but that seems to me also what's happening in Europe, between sort of the European level, the ECJ decisions, and national court jurisdictions. Appropriately used, the ECJ can be a wonderful foil for national jurisdictions, but also do them a huge service. Now, of course, complexity, make it complex, make it uncertain, has huge risks. So like any sort of type of guerrilla warfare, you have to be prepared to fold every now and then. And there's another problem there, is that this sort of guerrilla tactics fit very well with sort of warfare. When states do it, we may be a little squeamish about it because states should stand for certainty of the rule of law and all those things. But it seems to me that we shouldn't get too hung up about that. Those ideas have been developed mostly in the context where the state holds all the cards. This is not a context in which the state holds all the cards, so the state shouldn't be afraid to not necessarily play dirty, but at least introduce a little bit of messiness. Now, a couple of the points that were covered. So Eduardo spoke about the digital economy and data protection and the sort of the special problems that will arise there. Jan made a point that I had on tariffs, and the fact that it would have been useful to see the same 3 examples used in Section 3 again. I won't go into this. Just one final point. It seems to me that maybe, I would like to see more about the real cost of state purchasing in industries other than pharmaceuticals. The informational costs may be high, but maybe they will not be prohibitive, and my expectation is that they would tend to fall over time. So one could imagine a regime in which, iPads, in my guerrilla warfare model, so you're not looking for a general and clear model that applies across all products in the Apple range. You're just looking at the iPad Pro, or you're just looking at, what sells most. You could set up some kind of database where people register their interest. You tell them that, we're trying to aim to get a lower price here, so, maybe we won't be able to get you every model you want. But we will achieve our goal there. I would like to get you to say a little more about what makes you sort of discount that solution in sort of a, say, consumer retail context outside the sort of pharmaceutical and maybe defense settings. Thank you so much.
Thank you very much, Mitchell. You have 1 minute to answer. No. You have 5 minutes. If you
How much, seriously, how much time should I take?
5 minutes, please.
5 minutes? Okay, great. Well, thank you so much to the three of you. I've presented this paper in a number of fora at this point, and this is easily the richest, most useful set of comments that I've received. So I really want to thank you for that. So let me just cover. There was a lot there. Just cover a few highlights. I agree with most of what has been said by the commenters. In terms of John's comments, I'll mention two aspects. So one, your first set of comments about complexities on both dual residency, so where the host jurisdiction may claim residence. I agree that's a complication because it's going to blend in with the issue I was starting off with, saying that there aren't meaningful constraints on residence-based tax versus source-based tax. So that will create an instance where you have overlapping attempts to capture this, and that's certainly a problem. In terms of the issue of the synergies and the issue of the rent really being attached to multiple jurisdictions, I think that's a broader problem related to what we mean by location-specific rents, which we use in the paper but don't elaborate on. That's a separate project I'm working on right now and struggling with to try to give a more formal definition and conceptual analysis of that idea. So stay tuned for that. I'm working on it, but struggling with it at the moment. In terms of, so this came up in two sets of comments in terms of carrying on the examples, and then Jan also had raised some particular technical questions about tariffs and WTO law. So I confess here, I came in this project as a tax person, and Joe Bankman's a tax person. We brought on Al Sykes as the trade law person, and I've learned a little trade law in this process, but not a lot. And continue to think these are very siloed disciplines in the level of international organizations, level of practitioners, level of scholars. So part of what the paper is trying to do is break that down. But I confess I don't have a lot of technical knowledge here. I tend to defer those questions to my co-author, Sykes. What's interesting is as we drafted it, the tax section was drafted first. We fully assumed he would carry on with our business model examples, and then he told us, I'm dropping them because I don't think they're relevant. That disappointed me as well. So maybe I can go back and push on that, but that's how that evolved. And I know as a matter of exposition, it made, I think it's frustrated some readers that it's in one half and not the other. Eduardo, I love the comments about more expansiveness. I think you have two aspects of your comment there. So one is more legal regimes, and two is about how do we use the funds and how does that feed back into the overall analysis. The first one seems more doable to me than the second. The second is maybe intractable, even correct. The first I really like, especially the idea of data privacy as a means of rent collection. What's interesting and complicated about that is the way in which we think in the pharma example of you can essentially collect rent by delivering a benefit to home country consumers via lower price. And that example suggests, you can deliver rent to home country consumers not necessarily through a price or subsidy mechanism, but just by, in-kind delivery of some kind of benefit, for example, preservation of data privacy, might not think of in price terms. So that's quite fascinating. And then lastly, I'll just say on Emmanuel's point, I love the Art of Tax War. I mean, I thought this was a pretty catchy title. This one's better, so I'm going to take that. On one of the slides, I glossed over, there was in bold a bullet point. It said, why focus on rents rather than profits or income? And I didn't talk about that in the interest of time. You're absolutely correct that most of what we say, if you think of it as a playbook of comparative utility of different instruments, you might say, oh, this applies for profits taxation, whether it's a rent or not. I agree with that. The reason to focus on rents, I guess, is twofold. The thought that, one, they are uniquely attractive as non-distortive taxes if you can isolate the rent space, which we know is difficult to do. But they are uniquely compelling in that way. And second, it seems to us that the rent story does tie into the market power story in an interesting way. So sure, if there's no rents on either side, just in conditions of perfect competition, some of what we say will be relevant to what jurisdictions want to do, because there may be legal constraints on reaching foreign entities. There may be informational constraints. It's relevant, but that doesn't seem like a market power story. That's just the kind of textbook standard, do I trade off revenue for capital, and how do I make that trade-off? And so I guess the answer to that comment is yes, correct, but there's something interestingly distinctive about rents that makes it worth highlighting them, which is not to say that we can't also use some of this in other areas. All right, there's really, again, a wealth of comments. We could talk about this for a long time, but I don't want to eat into Eduardo's time, so let's stop there.
Thank you very much, Mitchell. Is there, yes. Is there any other comment or question from the floor? Yes, one question from Germany.
It's not necessarily too German, so I have two questions, but probably should limit myself to one for reasons of time. So, you categorize according to tax and non-tax instruments to capture MNE rents. My question is, wouldn't it maybe be more insightful to categorize according to different strategies, namely actually capturing what is accruing to the MNE as a rent, for example through tax, or directly converting a potential MNE rent into consumer rent? And why do I think this could be a more interesting way of categorizing? First, gives you better intuition of potential instruments. For example, anything that takes away a monopoly position from the non-resident MNE is the second part of strategy. For example, you could offer a lower level of IP protection, could have the same positive effect. And second effect of having this kind of categorization is you might add a political economy dimension in that states might be more interested in the first approach, because that gives them extra control of who actually then gets the rents, because they can redistribute according to what they feel is political priority, well, supporting lower class, middle class, whatever. Whereas the second strategy, they have less control of who then actually gets what would potentially be an MNE rent.
Thank you. Yeah, I agree with all of that. It's a great point. It's another instance where the exposition and form of the paper, unfortunately, is an artifact of co-authorship and relative expertise. So if you say, why do we carve the world that way? Not because that's the best way to carve the world, but because we sat down, okay, we'll write this section, you write the other section is how we'll label it. But I agree, that is a really interesting way to think about it. I'll just add one other aspect, which we don't deal with in this paper, though I think is important, is the choice of instrument is not independent of the long-term amount of rent in the economy. So shifting between exercise of state market power directly versus keeping things decentralized and taxing it, we would expect to have dynamic effects about what the market looks like in the next period. And this our way that we slice it obscures that, but I think the way you're suggesting of thinking directly about that as a category would make it that more plain. So I love the comment. It's unlikely to make its way into the final paper, but it's going to affect my thinking on this going forward. So thank you.